Hi everyone, Vlad here. Today we're going to talk about 5 reasons why recent interest rate increases may hurt you and a few tips on what you can do about it. A lot of you asking yourselves the question of whether we were or still are in a real estate bubble. And my simplistic and intuitive definition of a bubble would be if we had increases in housing prices that were in double digits over an extended period of time, followed by a very sharp decline over a few months, then yes, most likely that would be a bubble to me. Looking back at the events of 2017, they fit my simple definition of a housing bubble very well. So my opinion is that yes, we were in a housing bubble and it's now burst. As many of you may know, in 2009, the Bank of Canada decided to drop interest rates to below 1%. And that started with the economic crisis in the United States, nearly brought world economies to a screeching halt. What followed in Canada, and especially in GTA, is that housing prices started growing at a tremendous pace, far outstripping average household income. The current rate increase is from 0.5 to 0.75. On the surface, it seems insignificant, and in fact, it should be almost negligible. But when you look at the effect on the psyche of the market participants, it's quite dramatic. Prices for real estate in some pockets in the GTA have dropped by as much as 25 to 30%. So let's talk about those 5 reasons that I promised. If you guys own a house, and depending on the type of mortgage that you have, whether you're on a fixed or variable, the situation would be different. If you're on a fixed, you have obviously nothing to worry about for the term of the mortgage. If you're on variable, most likely your monthly payments will not change, in that your ratio of payments towards, or contributions rather, towards the principal and the interest may change, but the payment will remain the same. For those of you that are on a different contract, which is less likely, or we encounter less often, is that the monthly outlay may actually go up a little bit. Number 2, if you have a lot of debt and a lot of savings, what a lot of people believe is that the announcement in July was the beginning of a series of interest rate increases. And this is correct. Then over the next few years, we'll see interest rates at a much higher mark than they are right now. So what that will mean is that it will make it more difficult for you to make your mortgage payments if you have other debt. So get rid of it if you can within the next year to 2. Now I want to address the younger generation. For the younger generation, this is really the only reality that they've known in the last 7 to 8 years, in that the money was almost free and the housing prices were out of control. Look back at what happened in the GTA in the last 10, 20, and 30 years, and you can calm yourself. Things will change in the years to come. First of all, real estate prices always go up over time, and this pattern has been evident over the last 40 to 50 years. So take a look at it. There's nothing to worry about. Things will change, and things will change for the better. Next point, student loans. If you guys are carrying a student loan, again, depending on whether it's fixed or variable, your situation will be different. For a fixed, you have nothing to worry about. For a variable, your monthly payments will go up, unsubstantially, but they will go up. And lastly, I want to say that try and keep your credit score as high as possible, irrespective of what's happening with the economy, with the real estate market. You will afford yourselves the best rates rather with the 5 Canadian chartered banks if your credit rating is above 700. Keep it at that mark or above if you can. That's it. That's all the material I wanted to pass on to you. Thank you. And as always, we transform dreams into reality through strategic home ownership and real estate investment. Please look up information on this topic and many more on our website, www.mitramoves.com, or feel free to reach out to us directly at 416-835-0038. Bye for now.